Let's set the scene. It's January 2026, and a seismic shift is already underway in the global financial system. The very definition of a safe asset, the bedrock of investing for decades, is being completely rewritten. The old rules are breaking down, and it's sparking a frantic worldwide search for a new, reliable store of value.
Now, this isn't just a typical market downturn. According to seasoned analysts like Peter Carlin, what we're witnessing is a true structural crisis. When he says we're entering a period of extreme chaos, he means the fundamental order of things is breaking. And this isn't something that can be easily fixed with a simple policy change.
The root of this chaos, really, is a deep erosion of trust. Trust in the assets that have propped up the entire global system for generations. And that leads us to the central question of our analysis today. What happens when that bedrock, those so-called safe assets, finally starts to crack?
Okay, so the first major crack is appearing in the government bond market. For decades, U.S. Treasuries were the ultimate safe haven, the go-to asset. Well, that's changing. And, funnily enough, the trigger is coming all the way from Japan.
To really grasp the scale of the problem, you have to look at this number, 250%. That is Japan's national debt relative to its entire economic output for a year. It's an absolutely unsustainable figure, and it's forcing them to make some very tough decisions that are now sending shockwaves across the globe.
So here's the direct cause and effect. Japan's currency is under immense pressure. To keep it from collapsing, the Bank of Japan has to step in. To get the US dollars they need for that, they have to sell what they own. And what do they own a lot of? Over $1 trillion in US Treasuries. So they're selling, creating this constant downward pressure on the world's most important asset.
You might be asking, why don't they just sell their gold? Well, this table tells the story. Look at countries like Portugal or Germany. They hold over 75% of their reserves in gold. Japan, less than 7%. They simply don't have the gold reserves to weather this storm, which leaves them with only one real option: sell their U.S. bonds.
Now, as you can imagine, this instability in the bond market is making a lot of big money very nervous. It's forcing institutional investors to completely rethink their entire strategy. And we're seeing a clear, accelerating move out of paper assets and into hard assets.
This quote from Peter Carlin really captures the mood. It's not a gradual shift anymore. It's urgent. He can smell it. The big funds are no longer just dipping their toes in. For them, getting exposure to precious metals is becoming a mandate. It's a we have to have it now kind of situation.
And the data backs this up. Market flow analysis is showing us a systematic reallocation of capital. We're tracking hedge funds, commodity trading advisors, and they are actively moving money out of traditional financial instruments and piling it into the precious metals sector. For these big institutions, there are really two main ways to get this exposure. They can buy physical bullion, which is great because you own it outright, no counterparty risk, but it's a logistical nightmare. The easier path, and the one most are taking, is through exchange-traded funds, or ETFs. They're liquid and easy to trade, but they come with their own set of serious risks, which we're going to come back to in a moment. And hey, if you're finding this analysis valuable, please take a second to like this video, share it, and subscribe. That way you won't miss any of our future updates.
Now, this rush into hard assets isn't just about finance. It's also being supercharged by geopolitics. The global race for technological and military dominance has turned certain metals, especially silver, into critical assets for national security. And this is a huge paradigm shift. We're way beyond just thinking about industrial supply and demand. A country's access to metals like silver is now a core part of its national security. It's kind of like when the British Navy switched from coal to oil a century ago. It was a strategic imperative. The same thing is happening now with the metals that power our modern world.
And silver is right at the center of this perfect storm. You've got demand coming from every possible angle. It's still seen as a monetary metal. It's essential for electrification. It's critical for the build-out of AI and data centers. It's used in advanced weapons systems. And on top of all that, you have nations like China actively stockpiling the physical metal.
And this stockpiling isn't just about saving for a rainy day. It's part of a deliberate strategy called asset neutralization. The main goal isn't just to use the resource yourself, but to control it so your rivals can't get it. This kind of strategic denial adds a whole new layer of demand that has nothing to do with traditional economics.
So, as this new market structure takes shape, it's absolutely critical to understand the new risks that are coming with it. Our analysis points to 3 core vulnerabilities that every investor needs to be watching very, very closely.
First is the risk of a structural failure in the ETF market. This is where the price of a paper claim on metal, the ETF share, suddenly disconnects from the price of the actual physical metal because there just isn't enough to go around. Second, the potential for delivery halts on major exchanges like the COMEX. If they can't deliver the physical metal they've promised, you have a massive crisis of confidence. And third, the inevitable result of all this: wild, chaotic, unprecedented volatility across all markets, as the old system phrased.
And just to hammer home how serious that first risk is, the late great analyst Jim Sinclair gave this very stark warning. He's suggesting that the hidden dangers inside the ETF structure are far more severe than anyone realizes, and the fallout could be absolutely incredible to watch.
So, as the world redefines what it means to be a safe asset, we're left with this critical thought. In this great shift from paper to physical, the real challenge isn't just about spotting the next big opportunity, it's about understanding the profound new risks that appear when the very foundations of the market start to crumble.